Morning, everybody. I'm Nick Brummer. Welcome to one of our webinars. We've done a series of these. Oh, sorry, can you just hold on one sec, please? Thanks, sorry. Just getting the slides up and going here. Good, thank you. So this morning I'm joined by Johann Els. He's the group Old Mutual Group Chief Economist. Johann, thanks for joining us today. There's a lot of content we're going to cover today. We're really going to take an approach of asking Johann a lot of questions. A lot of questions have been submitted for this webinar. I've got quite a few key issues I also want to ask Johann. Just want to give you a quick intro. This is our team at Investonline. Investonline are independent financial advisors. We are a team of 13 and growing. And we have a whole lot of services which include financial, obviously advice and financial planning and investment management and some other services, which is also insurance and life products. We do modeling for retirement and obviously blend that with the investment strategy. What I also do, and I think is just relevant to this conversation about economics, is I manage a unit trust called the Prosperity Fund. The Prosperity Fund has done well. It's really for retired folk. It's managed fairly conservatively. It's had a return of 10% per annum over the last 10 years, which is well ahead of the average balance fund, which is 7.4% and inflation of 4.8%. I think the relevance of it is, with our chat today about economics, is having a view. I certainly have my own views. I don't always agree with other economists, sometimes not with Johann either, but that's what the market's all about. So we can enter Johann, and Johann, thank you very much for being with us. The first question, we just dive straight into it. We're going to start talking about the local economy. And I think certainly economic growth over this year has been disappointing. I know economic growth has been disappointing the last 10 years, but I think mostly this year there's been a lot of positives that have happened over the last 12 months, such as load shedding coming to an end, interest rates declining this cycle from like 8.25 down to 7. We've had an injection for the consumer out of the two-pot system of about 60 billion rand. Rail has started to improve as well. Home affairs, new job work permits have increased significantly. So there's been quite a big boost, and the economy still is just not kicking off. And I think it's disappointed a lot of economists as well. Can you give us some kind of insights of what do you think is happening, or is this just a lag effect?
So, hi, good morning, Nick. Thanks for the opportunity. Yeah, South Africa has certainly suffered significantly because of uncertainty around politics, policy. So we've had a confidence deficit for a long time, and that clearly has been impacting significantly. So, Nick, I'm just trying to share my slides, which worked well before we started and now not so great. So let me just see what I can do to get that going. But the confidence deficit, if we think about it, South Africa came from strong economic growth in the 1960s and 70s. And then came the sanction period with a significant trend of weaker economic growth through that sanction period into the early 1990s. Then came the new South Africa. And that new South Africa then helped significantly in terms of a confidence boost. strong confidence in the then politicians, starting with Madiba and then with Thabo Mbeki, Trevor Manuel as Minister of Finance, Tito Mboweni as the late Tito Mboweni as the governor of the central bank at that stage. So then we had a significant period of strong economic growth, and that helped significantly. And if we look at this graph, for instance, where economic growth is represented by that orange line. So in that green shaded period, 2004, 5, 6, 7, Thabo Mbeki president, Trevor Manuel Minister of Finance, Tito Mboweni Governor of the Central Bank. Strong economic growth. But the red line here is a result of a survey done by the Bureau of Economic Research at Stellenbosch University, specifically asking businesses, are you concerned about politicians and their ability to make and implement the right policies? And that red line, when it was low, it means virtually no concern or very little concern, which is, in my mind, the same as strong confidence. So strong confidence drove that strong economic growth. If we think back to the late 90s, perhaps you and I are old enough to remember, we still imported video machines and DVD players and CD players. Now, of course, we don't know what that is, but still, then the then government cut import tariffs quite significantly. So those products became so much cheaper. That's part of those good policies. And of course, that's the opposite of what Trump is doing now. But strong economic growth when confidence was strong. Then came the global financial crisis, and then came the Zuma years. And that concern about politicians moved up rapidly, as you can see with that red line. So collapse in confidence led to a collapse in economic growth. That makes sense. If we as consumers or businesses are not confident about what's happening out there, then we're not going to invest or spend. The Reserve Bank did a study linking confidence versus growth. So instead of the 1.1% annual average growth over that period, which, as you know, is virtually nothing. So instead of that, had confidence been the same as in the green shaded period, 2004, 5, 6, 7, growth would have been above 2% on an annual average basis. So that's our issue in South Africa. Problem number one is lack of economic growth. The reason for that is the lack of confidence. And even in the latter years of that pink shaded period, when Ramaphosa was president, we had the Ramaphoria, 2018, didn't work. And we just kept on with this disillusionment that nothing what they do will help. And of course, what we need to do is get that confidence going. So, yeah, also very volatile economic growth over the past, but I do see signs. There's some grassroots out there. We're making some inroads in terms of this structural deficit, the failings of state-owned enterprises, the structural issues around electricity, logistics, water supply, the electricity grid, where government has allowed the private sector a far bigger role in the economy. And essentially, we've almost sorted out the electricity issue by significant private sector investment there. Now we, through Operation Vulindlela and some of the government departments, Baba Creasy, Minister of Transport, for instance, easing regulations, making it easier for the private sector to get involved. Electricity was the first strong example. Now private sector able to get involved in Transnet's operations, the logistical area, for instance, easing regulations, making it easier for the private sector to invest in the electricity grid. So these things are taking a long time and too slow, of course. We don't want it to be so slow, but it's starting to work. And then a more shorter term issue is the cyclical side of the economy kicking in. That's the much lower inflation, and on top of that, lower interest rates. So we've seen some of the benefit there. We've seen a significant uptick in consumer spending, retail sales, car sales. And yes, you mentioned the two-pot money. That has helped significantly. But also the combination of somewhat better confidence after the elections and the formation of the GNU last year, lower inflation, lower interest rates, two-pot money, and also even in a very weak economy, over the last 3 years, we've managed to create 2.2 million new jobs. So there's benefits for the consumer out there. So I certainly think we can actually move from this weaker growth towards medium-term growth of around 2.5% to 3%. on the basis of this bigger private sector participation in the economy. The private sector sorting out these issues where government has failed, where state-owned enterprises have failed. But be sure, we're never going to get to 5 or 6% economic growth. Never. Think about all the negatives that we collectively can think about in South Africa, whether that's politics or whether it's as simple as potholes, because that impacts on our confidence in this economy. Failure of state-owned enterprises, but failure of municipalities. We forever hear about Joburg and the robots. That doesn't work, even if there's electricity. So all of these issues, but for me, the two biggest issues around never getting to 5 or 6% economic growth is the skills deficit. We've done nothing about the education system over the last 30 years. Incrementally, we're allowing better immigration, skilled people, but even if we do the right thing about the education system, today it's going to take 10, 20, 30 years before we have all the skills we need. Plus, the other part is also labor market, and that's a regulated labor market that doesn't allow faster employment growth. So I think there is some positives that we can get from the 1.1% growth towards 2.5 to 3. We're never getting 5 or 6. But the 2.5 to 3 will start to make a difference in terms of profitability, in terms of foreign investor sentiment, in terms of how you and I feel about the economy. It will drive better profit growth. It will drive the markets a little bit. I certainly happy to take 2.5 to 3. It's almost 3 times what we had.
Yeah.
But be sure we're never getting the 5 or 6.
All right, so it sounds simplistically, you mean confidence. I know that we all spend ourselves when we feel more confident, that this confidence level needs to come back, and a lot of that is going to be determined by political stability and obviously the right political policies being made. Obviously, we've seen a very low confidence from foreign investors that have continued to pull out our equity markets. But we also need, obviously, the confidence locally from local business, which have got rich balance sheets with cash to actually start spending money in the country.
Absolutely. So the local investors, they seem happy to start investing in electricity. We've seen significant electricity investments in those solar farms and wind farms. But as you're probably thinking about the big cash on balance sheets by companies that sits out there that hasn't been invested. So it's a two-way street. We need to continue to build the confidence. And I think to some extent the involvement of other political parties within the GNU drives some of that. There's lots of frustration there, but we need to build that confidence. Just as an aside, a lot of that cash that people talk about that sits on the balance sheets, probably not investable. Some of that cash is what medical aid funds and pension funds need to hold, but there is certainly a big number sitting out there. In terms of foreign confidence, I think in this era where we talk about concerns about policy in the US, where investors starting to see that perhaps the US isn't this typical safe haven investment that it used to be. Slower growth coming, Fed rate cuts coming, the dollar is weakened, higher deficits on the fiscal side, higher debt ratios, worries about policy in terms of the independence of stats agencies or the Fed, those kind of issues, where perhaps foreign investors starting to see better environment for emerging markets. And if you give me another second or so, let me share one graph where, adding on to the SA story, where people continue to think that South Africa is a failed state. In this environment where there's perhaps a risk on trade and South Africa is not the typical failed state, that I don't think we're a failed state, foreign investors might be happy to invest in South Africa again, as we might get our share of that investment in emerging markets. So absolutely, if we look at this, there are certainly lots of failings in South Africa, failed state-owned enterprises. And I'm not going to argue that we haven't got any corruption. We've got significant corruption issues, but the relative here is important, the perspective. South Africa relative to similar emerging markets. So the graph on the left, we always thought that we're the worst in the world in terms of corruption. But when we look at World Bank data and compare ourselves to typical emerging markets that foreign investors compare us with, that's usually Argentina, Brazil, Mexico, Turkey, Russia used to be in that grouping. I've also got the two big emerging markets, China and India, on there. The worst in Africa is Zimbabwe, to show that no, we're not a Zimbabwe, or not on our way there. And the best in Africa, Mauritius and Botswana. So that graph on the left shows the thick blue line, South Africa. So we're absolutely not the best. In this grouping, this universe, it's Mauritius and Botswana. The worst one, Zimbabwe at the bottom. So we're not the worst. We're not the best, but we're sort of better than the others. If you look at that graph, we're better than India, we're better than Russia, we're better than Argentina, we're better than Turkey, we're better than Brazil. So we have issues, but we're not the worst in the world. That same story holds for political stability. We took a knock in 2021 because of the unrest in KZN. We've since recovered, and no, we're not the best, but we're not the worst. We're sort of better than the typical emerging markets that we compare it with. The fragile state index, well, it swapped around, the worst one is at the top. Same story. My point here is that when there's concern about the US as a safe haven investment status, when there's weaker returns in the US versus better returns possible in emerging economies, South Africa is not the worst in the world. South Africa also, then foreign investors keep on highlighting to me that they understand that we've got a great constitution, we've got checks and balances, we've got a sophisticated financial sector, so it's easy to get the money in and out. There's no forex controls on foreign investment, strong institutions in the Reserve Bank and Treasury. We stand out relative to some of these other emerging economies.
Yeah.
It will stand us in good stead when there's somewhat better economic growth also coming.
Yeah, thanks, Johann. You mean, yeah, so a lot of times there's quite a bit of wishful thinking that when there is flows into emerging market, SA is going to get their piece as well. Unfortunately, we've been declining on a weighted basis, and the proof is going to be in the pudding when the foreigners start coming back into our market. But I think also a lot of the time it's also the locals where they want to see local business also starting to invest in SA. Just talking a little bit about unemployment. There's been quite a bit in the press, Capitec, talking about our unemployment rate, including the informal sector. So unemployment currently at 33%, which obviously is a big problem. But they're saying if you had to count the informal sector, unemployment would only be about 10%. I mean, what do you think about that?
I think there are issues with the surveys, the unemployment and employment data in South Africa. It's based on a survey. It's not seasonally adjusted. There are a bunch of issues with the data itself, but I certainly also believe that should we take better measurement in the informal sector, actual unemployment is lower. Having said that, though, if we compare ourselves to the rest of the world, then what Stats SA is doing, they're using the official International Labour Organization definition. And by that definition, our unemployment rate is around 33%. Okay. But yes, lots of people are able to make some kind of living in the informal sector. So yeah, there's a fudge in between there somewhere but absolutely it comes back to the lack of economic growth. We need more sustained, higher levels of economic growth before we can make any inroads in terms of that official unemployment ratio. It takes a while. Just briefly again, this graph on the left here that suggests in the good years when we had strong economic growth, the green line in the green shaded period, unemployment rate came off. With weak economic growth, the unemployment rate went up substantially. So it's going to take some time.
Yeah, obviously a very sad situation. Just moving on to inflation. Another big talking point at the moment is SA reducing their inflation target down to the bottom of the range of 3%. I know that this is debatable. There has been some views that it's not going to be that positive for SA, certainly in the short to medium term. I mean, what is your view on lowering the target range to 3%?
I think it's an absolute ideal opportunity to do it. There's a window of opportunity now, and I think the Reserve Bank grabbed that opportunity because this graph on the left shows with inflation at 3%, the bottom end of that 3 to 6% target range, ideal opportunity, because we know that on a base effect basis, inflation is going to drift up later this year. We've sort of reached the lows, and if you think about inflation expectations, the other two graphs on this slide, then that's going to start drifting up again. Just a major point on the left-hand graph, where I plot inflation versus the rand exchange rate. In previous cycles, when the rand weakened substantially, inflation shot up. Since 2011, the rand has weakened quite significantly, but inflation, despite many cycles, has basically moved sideways close to that target band. And that's the benefit of having a strong target. So the Reserve Bank doing a great job. But I think it's also been the weak economy. It's been difficult to pass on the cost increases from the weaker rand onto consumers. Businesses had to absorb some of that in their bottom line. So profits under pressure, but they wanted to protect their volumes at least. So lower inflation target will bring lower interest rates. I think there might be a little bit of a growth sacrifice next year. I don't think it's going to be significant. I think had we missed this opportunity, it would have been more difficult later this year or into next year if we then lower the inflation target, and then interest rates probably had to go up. Now my assumption is that, having said that they're going to target 3% instead of 4.5%, that interest rates will probably move sideways over the next year or two, and then start lowering again. So I certainly think there's more benefits. In fact, I think there's a slight risk here that interest rates can go down later this year or early next year. And that my view that it's going to move sideways might be incorrect, because I think the Reserve Bank will want to present to us, you and me, business, government, that there's benefits in this lower target, and they want to probably present that early. I don't think it's a serious thing that there's disagreement from Treasury's side. The official target band is still 3 to 6. The Reserve Bank, back in the days of Jill Marcus and her MPC, targeted 6. Then from 2017 onwards, targeted 4.5. Now just deciding they can use the full extent of the range. Now deciding to target 3. It would be better if government comes to the party, because then officially set prices like education costs, electricity prices, all will gradually ease off closer to the target. But it is part of that, what I usually call open mouth operations by the central bank. That's the public relations exercise telling us this is what they're going to target. Gradually, you and me, in our mindsets, we accept that inflation will settle lower. Significantly more positives from that than negatives.
Okay, well, good. I hope so, because obviously real rates are very high at the moment. We've got lots of scope for rates to come down. And certainly the man in the street is desperate for some lower rates.
Yes.
Right, so another topic, just moving on, is the GNU. So I know you're not a political analyst, but just your view and terms of the GNU holding, and if anything, is there any kind of view on who might be the next leader, or let's call it the next leader of the ANC after Ramaphosa?
Yeah. Now, we've seen significant noise around the GNU. Firstly, lots of optimism in the second half of last year that, especially with the DA's involvement, we'll see some acceleration in terms of policies. And to be fair, we've seen a lot of benefits coming through in terms of, especially home affairs. We've seen significant improvements there. So certainly it's been helping. But then, of course, earlier this year, the uncertainty around the budget, I think that's to a large extent at the door of the Minister of Finance and Treasury, who didn't realize that they had to change. They can't just, as in the past includes the National Party government and in the past 30 years of ANC government, the Treasury just comes and presents the budget and Cabinet accepts it. This is a new era. So lots of uncertainty. And what the better political analysts also tell me is that most of the GNU participants, especially the two big parties, want to continue because they realize the benefit of this. Especially the DA probably don't want to leave. They don't want to be seen as being responsible for breaking this up. The ANC won't want to push them. So both of them, despite all the noise, they stuck in there. And I think gradually it will continue. The upcoming elections in 2026 in terms of local government will probably see some benefits there for both the DA and the ANC and some of the splinters, especially the big splinters like MK and EFF losing out. And then the next elections, in terms of the ANC's leadership, that's more difficult because at the moment that's the big risk, that the GNU will then fall apart. It seems that the big contenders would be the current deputy president, Paul Mashatile. Not so sure that that'll be a good choice. Ronald Lamola is out there in the wings. Haven't really got off the starting blocks in terms of a campaign. That's the uncertainty. There's lots of uncertainty around that. I think as we move beyond the local government elections next year, we'll start to see more clarity on who might be the next one. I think what is clear for me, though, is that we've significantly built the size of the middle class over the last 30 years, and specifically the black middle class. These are people in the cities aspiring to higher incomes. The sort of driving the policies of what the DA really stands for. Better economic growth, better lifestyle for everybody. They're not going to vote for the EFF or MK, but they cannot bring themselves to vote for the DA, having a white leader. So, but for me, that's the building block of not going back towards a EFF or MK as participants in a GNU. That's what the strength is. And I think both the ANC and the DA realizes this. The middle class in the cities, that's what's going to drive policies. And that gives me some hope.
Yeah. Yeah, so there's a lot of uncertainty. I mean, I cover, and get a lot of input from other political analysts, and a lot of them actually just say they actually don't know who's going to be the next leader of the ANC, and there's massive uncertainty. Let's just hope that the GNU holds, because that's, I think, very positive. All right, just moving on. Before we get on to offshore, just the last question. Everybody always wants to know the rand. What's the outlook for the rand? The rand strengthened. It's almost down to 17.50 this morning. What's your view over the next year or two?
Great. My favorite topic. Very difficult to forecast. You're going to get it wrong if you do a point forecast, but we have to put a number on paper. Nick, I'm a proud member of the Nerd Club of South Africa, so this is my favorite slide. And let me take 5 minutes in going through this. This graph shows longer term picture on the left, shorter term picture on the right, green line, actual rand dollar exchange rate. The blue line, a theoretical or fundamental valuation, taking into account inflation differentials. So when the green line is above the blue line, it means it's much weaker than what it's supposed to be according to inflation differentials. Now, a couple of key points, and perhaps important to note, let's go back in history a little bit, interesting stuff. Back in 1980, the first time the gold price went towards $1,000 an ounce. SA economy far more exposed to gold in terms of exports, size in the economy, employment, etc. So the rand strengthened significantly stronger than the fundamental value when that green line is below the blue line. Then, of course, not many people would remember this because you're all younger than I am. Die Groot Krokodil, P.W. Botha, that guy from the wilderness. Rubicon speech in the mid-80s. Didn't keep to the promises before the speech, so we had our own debt standstill, foreign banks demanding we repay foreign debt immediately. We couldn't, of course, the rand collapsed. That's that mid-80s weakening of the rand. Now, if the rand were to move to the same percentage change now than back then, the rand would be 54 to the dollar. The fact that it's not tells me we're not actually the basket case that we think we are. Then, of course, in December 2001, the rand weakened substantially, big current account deficits, other issues, etc. And then everybody in his dark who thought he knew anything about the rand forecast that the rand is just going to continue weaken. The rand actually came back. Lots of people took all their money offshore, and it took 12 years for the rand to come back to that value. So that's the risk. I don't think you should ever use the rand as a deciding factor to invest offshore or not. That's a diversification and a risk argument. In any case, the other point is that the rand has often in the past, especially in the early 2000s, come back to the fundamental valuation. The rand is now much weaker than what it's supposed to be. You can see that both on the long-term and the short-term graph. The actual fundamental valuation at the moment at the blue line, the last data point on the blue line is 11 Rand 54.
Sure.
I do not expect the rand to come back to that at all. But I think the fact that the rand is so undervalued, if we think about the reasons behind the rand, so weaker dollar, somewhat better economic growth later this year and into the medium term, somewhat easier to fix the fiscal situation, get the debt ratio down. We didn't go into that, but that could happen. The ratings agencies have got a far weaker or far higher debt to GDP ratio than where we actually are. So ratings are actually behind the curve. I think the rand can come back substantially in the short term. If we think about the example there in the COVID crisis, this weak point on the short-term graph in April 2020 was 1990 to the dollar. The easy forecast back then was that the rand will strengthen substantially. Difficult part was when and to what level. In the event, it went from 1990 in April 2020 to 1350 in June 21. Now, I don't think the rand will get a 13 handle as it did then, but I think the rand can easily get towards a 16 handle, meaning anything between 16 and 16.99. That's what a 16 handle means. I think there's even a probability of a 15 handle in the short term. Weaker dollar is a key driver there. The dollar has weakened substantially. The US is viewed as not the safe haven that it was. Trump's policies, Trump's impact on the Fed, all those kind of issues. The dollar can weaken further, potentially. Lots of investors, foreign banks saying that the dollar can test 150, 160 to the euro. I don't think it'll go that weak, but that's in there. So the rand can, in the short term, come back quite substantially, but then, of course, it'll drift again. But as we move into more sustained, slightly better growth, eventual next year or 2, 3 ratings upgrades within 4 to 5 years, actually back in investment grade ratings, plus then a lower inflation target. So that blue line's angle was differential of 2.5%. Our inflation at 4.5%, target, US at 2%. Now that's narrowing to 1%. Ours at 3% and the US at 1%. So the rand can also become a little bit more stable in the longer term.
So, yeah, well, thanks, Johann. I mean, forecasting the rand in the short term is very difficult. I know other fund managers and other market participants are reluctant to forecast the rand. I mean, it's probably one asset class that people have got wrong mostly. But clearly,
forecast will be wrong. So the direction is what's important.
Correct. Yes. Yeah. All right. Thank you for that. Maybe just moving offshore, and probably the biggest talking point and the biggest uncertainty is US tariffs. So I know that it's moving around all the time. I mean, Trump has again extended China's negotiation out again. But now, per The Economist, the effective average tariff is 18%, which is up from 2%. So it's still quite significant. How do you feel that much higher US tariff is going to affect global economic growth?
I think of the 3 big areas in the world, US, Euro area, China. China's growing around 5%, and incremental policy will probably keep growth at around 5%. So decent growth for a huge economy like that. Euro area, actually, Trump's policies around MAGA, Make America Great Again, is impacting on Europe in terms of make Europe grow again. Trump's policies towards defense spending in the euro area, significant spending on defense, but also the new German leader that has said he's going to cut taxes, forego all those fiscal rules that has been part of the euro currency, spend more in terms of infrastructure spending on top of defense spending, tax cuts, etc. So lots of support for the other 2 big areas, whereas the US is probably going to grow a lot slower. The leading indicator index is slower growth, policy uncertainty. On top of that, labor market has started weakening. So at least the rest of the world seems to be growing okay. Euro and China and other emerging economies also doing better because lower inflation and lower interest rates supporting economic growth out there. I think in terms of trade issues, I think that eventually US consumers will turn around and say, hang on, we want cheaper products from offshore, TVs, washing machines, fridges, etc. They will eventually drive a turnaround in these trade policies because they're going to bear the brunt of higher costs. Some of the exporters from other countries to the US will bear some of that cost, absorb some of it. Importers in the US will absorb some of it, but consumers the bulk. We've already seen customs taxes, the take from US Treasury rising significantly. Signifying this higher tariff. So I think free trade outside of the US will continue strongly. We see that countries are seeking other areas to export to. South Africa is doing the same in terms of lots of the agricultural exports. Free trade, globalization will continue strongly. US consumers will eventually demand they come back. So I think this is a interruption. Perhaps the interruption is longer than what we thought from Trump's first term to the end of his second term, and then gradually it takes some time, but the US will eventually come back.
Okay. Thanks, Johann. I mean, listen, it's fascinating because, certainly global markets are ignoring it completely as they continue to make new highs all the time. Which sometimes I find quite baffling at this stage. But let's just move on to an area which also is boosting certainly the US markets, and that's AI. Everybody talks about AI. And the issue is, when will AI, in your view, start making a meaningful contribution to global growth?
That's a difficult one because I think it's already making some contribution, and that contribution will probably grow, but meaningful, that's very difficult. Is it next year? AI is growing so strongly, perhaps it's next year already, perhaps it takes a while. Meaningful is difficult, but I think AI is already benefiting. We already see, and tie that into Trump's view that he's going to bring manufacturing jobs back to the US through his trade tariff policies. No, it's not going to happen. It takes much longer than that. I think AI is already impacting that. Costs are too high. Manufacturing jobs in the US have been lost forever and continuing to be lost over the last few months, and nothing of that's coming back, and AI will just exacerbate that trend. But AI might create other job opportunities. So AI is a difficult concept. I mean, you and I, or everybody that I talk to, are already using AI in our daily jobs. For me, whether it's just summarizing long reports or stuff and helping me being significantly more productive. So I think that productive issue, that's coming through already. Difficult to measure initially. Stats agencies are not so up to scratch in terms of measuring services sectors. It's much easier to measure what is being produced in a factory than the services issues.
Yeah. Okay, this is an interesting one. I think some of the studies that I've seen is that there's anywhere between 5 to 10 years where I feel AI is going to really start being noticed from a productivity perspective. We know the share prices are all going up. They're selling a lot more AI chips, but that doesn't mean that that's filtering through just yet into making us a lot more productive, like the internet did. So obviously, it is going to add a lot to all of us, making us a lot more efficient over time. Another big topic, interest rates. But I think the interesting part here globally now is, are we in a more secular, higher interest rate cycle than previously? The world was really spoiled for many years, having this very, very low interest rates. Inflation, as they call it now, is more sticky, higher than people expect. Are we going to have interest rates remaining higher over the next few years?
I think we need to split this out. I think US versus the rest. China sits with almost deflation scenario, very low inflation. euro area inflation numbers are surprising to the downside. The ECB, the European Central Bank, willing to accept that. They traditionally like low inflation, so they're willing to accept that. In the US, we've seen that inflation remains above target for longer than expected, that this uptick that we've seen recently because of tariffs will continue for a while. But even in the US, with much weaker economic growth towards the end of this year and into next year, the second round impact of tariffs on inflation will be limited. So my view is that inflation, even in the US, will come back probably only later this year into next year. But the Fed is more worried about the real economy. So despite inflation above target in the US for a while, still the Fed will start cutting rates because the most reactive central bank out there in terms of when there's weakness coming in the US economy. So I think the Fed will cut rates by 100 to 125 basis points from later this year, probably from September up till the middle of next year. So in my mind, the way I look at it, I think emerging markets, China, euro area, actually lower inflation. So further rate cuts in emerging markets. Euro area probably not cutting because they're willing to accept inflation undershooting their target. But yeah, you're right in the sense that before COVID, we had much lower interest rates. They've settled a little bit higher, despite the fact that rate cuts are coming in emerging markets, in US later this year into next year. Interest rate probably settle somewhat higher than where they were. But I don't think that's necessarily that bad. I don't think anybody expected them to come back quite to the levels where they were. They're certainly coming down from the peaks that we've had post-COVID. So interest rates are still coming down, not to the levels of where it was before COVID.
Okay. Yeah, I mean, it's quite a key issue that's regarding valuations and longer term valuations in terms of what you plug into your models. So again, there's varying views on this. But if rates are going to stay slightly higher than they have previously, even though they're still going to come down, it does make you question the level of global markets at the moment. Johann, we've covered a lot. We've had almost 45 minutes. Thank you very much for your time. It's really been valuable. Thank you, everybody, for joining us. If you have any, hopefully we've answered a lot of your questions. And we're going to have another webinar next month on offshore wrappers. Offshore wrappers are a fantastic product for South African investors. And we're going to go through the details around that again. So please join us. And we do a whole series of webinars, which you can actually find on our website, obviously investonline.co.za. Please go to our website and you'll see all our other webinars we've had. Johann, thank you very much. Really appreciate your time.
Much.
Cheers. Bye-bye, everybody.